Okay, hello everybody and welcome to another Learn It Live webinar for Pepperstone for the 11th of March 2020. And of course, we have seen some extreme volatility, as I'm sure everybody's aware, over the last 2 weeks. You'd have to, if you were a trader, you would definitely see it. And tonight's topic is quite timely. So obviously portfolio hedging during times of uncertainty using CFDs. So we'll be talking about, of course, hedging tonight, but we'll also be having a look at the markets and talking about patterns and all sorts of things. So let's get started. So what are we going to be covering today? We're going to be taking a look at hedging a portfolio and trading CFDs in times of volatility, how economic news impacts and moves markets, specifically the types of economic news that will impact the current markets, and of course, specific patterns and setups to keep an eye on. And then there's the live Q&A with our team at the end. So if you have any questions, please feel free to type them in. Just to quickly check, everyone can hear me. If someone could just type in the questions and let us know, that would be great. And yes, this video will be on Pepperstone's YouTube channel, so you can go check that out. All right, so just before we get started, I just want to always let everybody know that we have some Telegram groups that we would love you guys to join. So I'll pop those in the chat room and feel free to join those. Those are both free Telegram groups, so the Pepperstone one and our one. My name is Thomas from FX Evolution. And yeah, we really do encourage people to get involved there because it's a great source of news. And of course, our one's more of a trader discussion where people can share their ideas. So I would also like to just mention that, of course, this webinar is purely only for educational purposes, and the information in here should only be considered general in nature. Of course, seek your own independent financial advice if necessary before making any decisions. So before we get into anything else, I'd like to talk about market gaps. And the reason I want to mention market gaps is it's pretty much what we've seen coming off Monday. So market gapping is often misunderstood, and I want to kind of let people know what this is before we talk about hedging. So market gapping is when a trading instrument opens above or below the previous close price, generally with no trading activity in between. And of course, weekend gaps are particularly severe during times of high volatility. And a few of you may have experienced this, unfortunately, over the weekend. So let's just actually go into the markets, and we'll just bring up, let's say, well, even the ASX 200 is fine. And let's talk about just the gap that happened over the weekend. So here we've got the close on the Friday night. So obviously the ASX 200 closed at 61.16, and then we can see it reopened pretty much the next day. We've got that open at 58 on the Monday at 58.94. Now that's a fairly extreme gap in an index. It's actually a very extreme gap, and a good way of knowing when these kind of gaps get, let's say, more common is probably to check something like the VIX. So if you're checking the VIX, the volatility index, and Pepperstone does have that on their platforms, top tip, if you just go to right click in the MetaTrader 4 or MetaTrader 5 and then left click show all, you should be able to see all the different pairs that are offered by Pepperstone on the platform. But yeah, the VIX basically, when it spikes above 20 as a number, generally you will see more market gaps. And it's important to know that, because if you're seeing market gapping, then that's inherent risk to, of course, your portfolio, or inherent risk to the trade that you have in. So we may want to look at hedging opportunities during that time. So yeah, definitely massive gaps. Of course, oil had some of the biggest gaps of all. Oil, we were seeing gaps of about 20%, which is massive. And this is what happens during these economic times. Okay, so another thing we want to mention is that what is a technical bear market. So of course, with hedging, people are basically hedging uncertainty. So I want to talk about bear markets with indexes as well. So typically a bear market are when a decline of the overall market, like the S&P 500, let's say, exceeds a 20% decline or more over a sustained period. typically this time is generally considered to be 2 months or more. So we're seeing an extreme move here. If you saw like a flash crash like 1987, when if you ever get data on indices, you'll see like this just giant massive flash crash that pretty much crashed down and then fully gap back up. That's not considered realistically a bear market. What it is considered though is obviously a flash crash. A bear market is a sustained period of time where you've got a decline of upwards of 20% in an index. Very important to know. Thought I might also put this one in just for tonight, because I guess this is nowadays that we live in social media and emojis and sharing everything. It's kind of funny to see this kind of thing. So this is the multiple stages of market emotions. So of course, here's 14 stages of trading psychology and why it's okay not always to be the best, because obviously sometimes it does happen. So we've got that optimism, excitement, thrill, and then of course euphoria that we've seen on the S&P 500. And then now we're starting to see that kind of, well, we're definitely seeing anxiety and denial, because we did see the US 500 make higher highs. And then of course now we're in that fear, desperation and panic kind of area. And this is what happens. The market goes through these stages. Then you'll see like a capitulation where effectively the market might sit down at a level for a while and just wait there or find support or something like that. Despondency, and of course then you've got that recovery, which is, let's say, hope and relief. So just thought it was an interesting little chart to have up there, and it shows you more in the emoji way of looking at things. But if you look at any market and you consider you kind of the stages of the market, you will see that there's obviously always that optimism, euphoria, and then of course the fear and the panic brings in afterwards, followed by the recovery. So I've got a question here that might just be interesting. So what does the gapping help to achieve, and who's the beneficiary? So gapping basically is just literally the close price and the open price. In terms of who's the beneficiaries, I guess that's a very complex question that you could cover on another day, but effectively gapping is a thing of all markets. If you trade stock markets every single day, you will see these gaps. When you are trading over the weekend, of course, you expect some form of difference between the open and the close price, and that's just what fair value is on that day. So effectively, prices change like they change in the live markets, and when volatility happens and news changes, the fair value of that particular instrument may change, and that is that difference of the open and the close. Okay, so economic impacts that are moving the markets currently. So we obviously have things like the coronavirus outbreak and its spread globally. This is an incredibly important piece of news. Every day the market is reacting to this news. So if we have, let's say, the coronavirus spreading through Italy like it is right now in all of Europe, as the numbers go up, and especially as the uncertainty goes up, and uncertainty is the key word of tonight, then if more people are dying than we originally expected from that virus, and is more, maybe it's mutated, all these types of things, these will affect the indexes heavily and affect the market heavily. So you need to be aware of what the outbreak level is, and that is pretty much the news that is definitely moving the markets at this stage. If you see an uptick over the weekend, and the weekend, of course, in South Korea and Italy and Iran, all those countries are having even more spread of the virus outbreak, or maybe this weekend we see, I think the US is now over 1,000 cases confirmed, and it goes to 10,000 or something like that, you'll probably see some form of volatility based on that news. Then, of course, we've got the government stimulus into the economy. With the Australian economy, we've seen already that there's a package together to try to protect the economy or the indexes, and that was at least initially, positive for the market, and the market has moved up since then. But this is something that's going to be a story where we see this coming over the coming months, and I would expect that there'll be multiple packages of stimulus to come through for all of these indexes. Then, of course, the Reserve Bank emergency interest rate cuts. We'll have a look at how that affected the market as well a little bit later. And of course, economic figures coming out soon that will show the economic damage of the coronavirus to each economy. So you could almost look at that, I think it was the Chinese PMI or something. I think it was to do with the manufacturing basically, and its number was so bad, and then of course it was even worse than expected. And that was a clear reaction to what happened with the virus slowing down an economy. So I would expect March to be highly volatile as we start to see numbers that are affected by the coronavirus outbreak come in. Be warned, definitely keep following these areas. All right, so we'll just have a quick look at that market, and we'll take a look at what happened when certain things did occur. So load up probably the US 30, which is the Dow. And again, we will get into hedging. We just want to cover these bases first because it's very, very important to do so. So of course, here we've got that double rate cut stimulus. The market quickly sells off. Double rate cut stimulus of 0.5%. We do see an uptick in the market. And then of course, that's followed by, well, wait a second, we've got the coronavirus news, and that's actually worse than we expected. And then of course, you're followed by that sell-off. Now we've seen government packages and stimulus. If we go over to the ASX 200, we can see here that pretty much yesterday they announced part one of the stimulus, big bounce from that all the way into 6,000, and then now we're coming down after that initial euphoria wears off, and instantly we're back into, well, the coronavirus is spreading faster. Italy, I think, had 16 million people basically in quarantine. It's you know, it's a real deal. So absolutely, this is what is going to happen. We're going to see stimulus or cuts. Those things will boost the market. Then we'll see maybe if the virus worsens, then of course it will go down. Those kind of things are what you need to be aware of when it comes to fundamentals of hedging. Hopefully that makes quite a lot of sense. I'm sure it does to many people. So brings us on to what is hedging. So hedging, of course, can be considered an advanced investment strategy, but realistically, it's pretty simple. Hedging is all about risk management, and it's to reduce or eliminate the risk of uncertainty. Essentially, what we're doing is we're taking a position that offsets one or more positions you currently have open. So a very easy way of hedging would be, of course, that if we had, let's say, the euro US dollar, and we just got a demo open here. So let's just say we're in the Australian dollar and we wanted to, let's say, buy 0.1. We could do that. We could obviously press the buy. And then if we wanted to instantly hedge that position, all we would need to do is press the sell. Now that's a super basic hedge. Obviously you've got, you know, the discrepancy between the initial buy and the sell. But if you wanted to lock in a potential price before the weekend, but you didn't want to necessarily close the position, we could do this. We could hold this position over the weekend. We've got equal contracts each side over that weekend. And then on Monday, we could reassess what has happened. We could choose to close the hedge, or we could choose to leave the hedge in and close both positions. We have all these options to us. So that's a super simple, just hedge the exact thing that you are looking at, which in this case would be the Australian dollar. So let's say you were up on a Friday night and you thought, look, I don't want to take it into a highly volatile time such as now, but I am still interested in being that trade. You can then reassess that trade on the Monday after the weekend gap. So that's very, very common tactic that's used by many people. And of course, it is there to protect your position. You'll notice that the discrepancy is, other than spread change, will be very, very close. So we'll keep looking at that throughout tonight's webinar. So in essence, very, very simple. That's the most basic kind of form of hedge. Okay, so Frank said, I thought the news would have an impact on the gap. For my example is Monday night, Tuesday morning. So I'll get to a lot of these questions. Please keep asking them, and I will get to these at the end. I think we'll probably have a decent Q&A today with all these questions coming in. So that'll be really, really good. I got a question about how to just quickly here, how to trade a volatile market. Do we scalp, or what do we do? Look, that is a good question. I always say that if the VIX is over 20 or 25, you may want to change your strategy of what you expect out of a trade. So let's say you were in a generally you're in like a few week kind of trade. Obviously the market momentum in this news is so fast that you may want to change to your day trading strategy or scalping strategy. So you may want to be faster and quicker in the market. And the VIX is a great tool to be able to come up with that idea. So hedging is all about obviously eliminating the risk of uncertainty. We've seen what a basic hedge is, where you basically have a position and you create an opposite position that offsets that. But then what else could we do? So we could also potentially look at hedging maybe a portfolio of shares. So of course, Pepperstone does have several shares in CFD format, but we also have effectively a whole bunch of different indexes. So we've got the ASX 200, S&P 500, Dow, etc. Now, if you hold, of course, a basket of shares, so that would mean like several shares, and those shares may move, let's say they're all part of, let's say, the ASX 200, and they may move very similarly to the ASX 200 on a daily range, you could create what's called like a partial hedge, where effectively if you had those portfolio of shares and you wanted to protect the amount that they would go up or down, then you could do that by selling the opposite size of the ASX 200 against that portfolio size. So if you had, let's say, $100,000 worth, you could calculate, well, on average, if that's moving 1%, what's 1% of the index? Obviously 1% is $1,000, and you could create a partial hedge by selling the index position and obviously continuously holding your stock portfolio. So as your stock portfolio declines, the index hedge will increase because you've of course sold it, so you're waiting for it to go down. So that's like a standard kind of portfolio hedge. Now, of course, it's very, very important to consider that you need to have a portfolio that moves in unison or at least pretty damn close to an index, but it is definitely an option for people to look at. And hopefully that does make sense. So before we get into the charts, we want to talk about some patterns that we look for in these times of uncertainty. So specifically things like double tops, head and shoulders, pennants, flags, and symmetrical triangles are all very great patterns that you do want to be looking at. And I would say that these are some of the best patterns out there in terms of patterns anyway. I know a lot of people use all sorts of different patterns, teacup saucer, all these types of things, but realistically, these are the ones that the bigger guys do use in the markets. They're easier to spot, which is very important when it comes to recognizing an area that we may want to hedge our portfolio or hedge potentially our position. We need to see quality setups, and quality setups, if you need to take that ambiguity out of things. So we do have a trading cheat sheet that everyone can use. You can feel free to sign up for it. It's obviously completely free, and it looks like this, and it's basically something you can print off or have on your computer, and it just gives you some basic patterns and kind of take profit targets and those types of things that you generally be looking for. So obviously some great ones: double top patterns in a decline upon the market increasing, then of course a double top occurs and it starts selling off. Very, very nice patterns to see. Head and shoulders patterns can happen on the smaller time frames, and of course when a index or a specific thing may stop selling off, you may also see things like double bottom patterns. So if we go into the charts and we have a look at the US 30 and we just go to a daily, and we go back to previous crashes, so let's have a look at a previous kind of decline in the market. We'll just load those up. Then basically what you can see is sometimes double bottoms at the bottom points. So effectively, that would be the most common thing that I would suggest. Look for consolidation patterns. Now here, when the market came down over 2018, we saw a very nice kind of break of support at this zone, and then of course it shot down all the way to this point, reached or overshot, which often the market does do, came back up, and it didn't quite make a new equal low. But if you go through and you look at, I think it's 2000 and 18 the start and 2016 lows, all those types of things, look at them on a daily and a 4 hour, you will start to notice these kind of patterns occurring. So you'll have a market coming down, doing its standard thing, it'll hit the bottom, it will come back, and then it'll hit the bottom again, and then it will form something like a double bottom. And this is the market really thinking about the current price action, and it likes to go back generally to that price action. So it usually hits a low, considers that low, that might have been during the fear and panic phase, comes back up and it goes, oh no, wait, that news really is that bad. And then at this point here is usually maybe where you see policy change. Like, remember we mentioned we had that policy of the government starting to stimulate the economy. Maybe that's where the half-life is known for the coronavirus, which is something where effectively it could burn out. So that's a concept it's very well known in science. Maybe summer comes in the northern hemisphere and it's very susceptible to that. All types of things can happen down here, but this is often the pattern that happens. And actually it's this key point here where the double bottom breaks, and that's that technical kind of buy zone, that a lot of the bigger kind of investors will start to buy it because they've taken that uncertainty out of the position. So maybe they would reduce their hedges during that time. So we have a market coming down, hits that double bottom, comes back up. During this point here, potentially people go, okay, well, I love what I'm seeing. We've got the hope now, remember those emojis, and this is the point where potentially we could close off our hedge position and look to the upside. So it's just some ideas and things and concepts, but hopefully people get the idea of that. Now, conversely to that, if we were sitting over in this point here in 2018, we might say, okay, we have highlighted a zone, and that zone is right here. And we've said, okay, this is a super strong support level. If price gets under this support level, we are going to hedge the position. I still want to hold, let's say, US 30, and I still want to hold it long, or I still want to hold my stocks or whatever we're looking at. But when it breaks through such a key area, and I think with hedging, it's all about key areas, and it closes below, we might want to say, okay, at this point we hedge, and until it gets back to this point, I'm not closing my hedge. Hopefully that makes quite a lot of sense. That is definitely a very valid type of strategy or a type of concept that you can employ. And if you see the right levels and you're happy with that, and it gives you that confidence. Now, obviously, it's not without its own risks. When you lock in a hedge, that hedge is effectively locked in time, so it won't change. So the price will, as you've noticed here down the bottom, the price is pretty much within 10 cents of each other, just depending on the spread widening. But it won't close out because, of course, it isn't affecting our overall equity enough. But yeah, effectively what we'd be doing is we would be saying, okay, we want to close the position when it comes back to this point. Now, that's just something that you could consider. It's definitely a good technical level, and of course it did come back, but you would have reduced your stress throughout this time. Got a question here. How about closing the hedge position with a profit before it goes back to the entry point? Okay, so let's actually just consider that US 30 again. You can absolutely do that. You might want to say, okay, we've recognized, let's say, this level here as a key level of support that we actually expected the market to get to. We weren't sure, but we're prepared to potentially close the hedge here, and then we'd be liking to buy this position again. So that's absolutely fine as well. That's definitely a valid concept to a hedge. So you might say, okay, we've taken it down. We're going to take it down for the distance of, let's say, this channel, which would be this distance. That would mean that we want to close our hedge when it hits that point, close our hedge, goes further. Obviously, we're not happy about that, but we have taken the profit from this point, and then the position moves back up. Now, one thing I always want to say, and we do videos on this, and I do this on our FX Evolution YouTube, so do check that out. I'll put it in the chart. But I was talking about how the market likes to overextend an area. So I think we saw that very clearly yesterday with the ASX 200 just absolutely flash crashing through the morning. I mean, the ASX 200 was absolutely underperforming every single other index. It was pretty bad when it hit that 53 kind of 50 area, and then it came back stronger than any other index. So the market likes to hit key levels and flash past the point. It always can outlast generally most people's psychology. It goes a little bit further. So here we've got that last day, and I do remember this. Hopefully a few people out there traded this or remember what happened here. We had that illiquidity coming into effectively Christmas. It was bad. It was a red Christmas, and the market just gapped down, just bang. It just went straight through, and that was because there just wasn't that many big traders around. The market was very easy to move when you have extreme fear coming in and you have illiquidity. It's actually one of the most dangerous times of the year for this to happen. So of course that happened, it overshot and then very quickly came back. So remember, the pattern says go here. It goes further. And I always like to break down things in trading to a percentage. So what usually happens is when markets overshoot, maybe 20 to 30% of the overshoot of what you think the range is the overshoot. So always think it goes that little bit too far for you to maybe handle psychologically. So remember those emojis. There's a reason why everyone makes similar mistakes when it comes to trading, and that's because the market is it's like psychological war in aspect there. So hedging stops the psychological war. It can protect you from that. And when that overshoot happens, you know, if you would hedge from this point here, of course, you would like, well, everyone else is way worse off than me, and I've taken some profit. And yes, I'm down on my other position, but overall, I'm pretty happy compared to everybody else. Maybe that doesn't affect you as badly psychologically. Very important points. I'll just quickly pop something in this browser. And I'll come back in 1 second. Okay, so I'm just going to share our YouTube channel with everybody as well, just because I do a video about the specific thing, and I thought you guys might like that. So check that out and subscribe if you'd like. So we've covered a few things. We've covered, of course, that there's several economic bits of news that are going to affect this market heavily. We're going to have incredible moves because of things like the VIX and the volatility indicator being so high. So right now the VIX is, you know, pretty much the highest point it's been since the GFC. We're over that 40 area, and that's very important because when the volatility is that high, the fast speed is that fast. We want to be probably looking at the smaller time frames and focusing on maybe considering the scalping and day trading strategies that we have in our trading arsenal. And that's just because the market will switch and change so quickly. And we'll see that throughout the next couple of weeks. Okay, we'll get back into some things we look for. So during hedging times, we also want to have like a business plan for our trading strategy. It's very, very important when it comes to hedging. We want to say, okay, we're going to enter based on certain criteria. So let's say it was price action, chart patterns, indicators, some charting techniques, and of course, we're going to use our risk management, and the ELD system here is just part of the course that we run at fxevolution.com. But effectively, if we have the risk management component, maybe what we can add or put in addition to our trading strategy is we have trigger points or trigger areas similar to what we were seeing on that Dow support, where we consider hedging the position. So maybe we say, okay, as part of our trading strategy and our business plan, we will always hedge into the weekend when the VIX is over 20. That's quite valid. Sometimes hedges don't work out for you and the market goes in one direction. But if we deem it to be, let's say we were buying the index and we went over a weekend right now, it could be very scary on the Monday like we have seen. So maybe you want to hedge buy positions, and maybe you don't want, you want to take the market risk on the sell positions. It's completely up to you. But if you create this into your business plan, it's very important. And that's probably the key. It's everything you do in trading, you need a business plan because it is a business. If you go and buy, let's say, a ice cream shop. You're going to want to do the due diligence on that ice cream shop. You're not just going to walk in there and say, okay, there's 3 people in here. I think there'll be 3 people in here in 2 hours time. They're always going to buy it. And that makes sense to me. So let's pay whatever they say. You're going to be looking at the numbers and doing all of these pre-work ideas because it's a lot of money. The same thing happens with trading. You want to scale your trading over time. You want to have a great foundation and base. So if we build in hedging as a strategy that we use, maybe during times of volatility, that could help us as traders. A couple of sound risk management strategies. Obviously, we want to be smart with our money. So risk reward is very important. We don't really want to be risking any more than 1 to 2% of our capital. But if you do that, then you need to realize you're taking more risk. And of course, we want those kind of 1.5 to 2 to 1 risk rewards. So, you know, very, very important. We don't have like 0.5 to 1. Sometimes scalpers and day traders, they can get carried away with this idea that they've got a 70 or 80% winning strategy, but they've got, let's say, $100 at risk and they're only making $20 per trade. The problem with that is that you have to be winning so many trades or making profit on so many trades, because one trade going backwards is equal to 5 of your winners. So you have to be very realistic about those types of things. And of course, you need to know when to get out of your positions and when to plan. And that comes back to that hedging idea. Okay, so I've got just going to go over a few of these questions because there's quite a lot of questions coming in. Let's go back to the start. Okay, so we've got, so dealing with gaps, definitely hedging is a way to deal with gaps. Specifically ones like if you had Euro USD or odd USD like we just did, we're just literally reversing the position, then we can use a clear mind on the Monday or clear mind on the gap point to find out what we'd like to do with that trade at that point. Okay, will sell buy orders get filled during the gap market or after? Okay, that's a good question. We get asked that quite a lot. So basically, yes, you won't get filled during the weekend. You'll only get filled on the next available price. So if the market closes over the weekend and it is just closed, it's not a constant 7-day-a-week market, you get filled at the open price, okay? It's very important. So if it closes at, let's say the index closes at 28.70, and then the next Monday it opens at 28.50, you get 28.50. Now, if that's gone past, of course, your stop loss. If it's in profit, well, the price is 28.50. But it's very, very important to understand that you will only get the next available price. Is it possible that hedging can fail? Of course, with portfolio hedging, yes, it is possible. You would want to, of course, do your own due diligence for everything. But when I say that, it just means that if you have the top 200 stocks, then of course, and you've got them all correctly identified, then yeah, it'll be perfect. You know, if they were correct and equal weighted, or if you did an Australian dollar and an Australian dollar, generally that would be absolutely fine. You'd need a significant spread widen to be a problem, and it will just won't be. But yeah, generally hedging is pretty okay from that aspect. How do you use the VIX? Okay, so I get this a lot. VIX is not an indicator, all right? The VIX is a chart which basically is just showing you the volatility. And generally, it's based on the S&P 500. So it's very, very good for times of, times like, I guess, right now. If the volatility is above 20, I always like to say, okay, we're in a highly volatile time and we may want to consider hedging strategies. Okay, another great question. What about the lockout that happened on Monday? So the circuit breaker of the S&P 500, but MT4 were not able to trade for 4 hours. Asking because I've never lived through one. Yes, now great question. That's from Total. All right, that's a good one. So yes, I actually did a video on that YouTube channel, our one, about this, about circuit breakers. Now, effectively what happens is there's actually 3 circuit breakers in the S&P 500, and there's a future circuit breaker as well. So the loss was so severe on the gap on the Monday that the market pretty much immediately went to 5% loss. That froze of course the order fill, and everybody had this, and basically they didn't reopen it until the market opened in New York. Now, it's very unusual that this happens, but it's a risk of trading. So with the circuit breakers, which is a little bit different, when the market's open, if the market falls further than 7%, the market will close for 15 minutes and then reopen. Then if it drops to 13%, the market will close again for 15 minutes. We haven't seen that recently, of course, since these rules were in, and then it will reopen. It does that to pick up for liquidity and maybe potentially stabilize the markets. And then, of course, the final circuit breaker, at least for the S&P 500, is 20% in one day. The market will close and cease from trade. So we haven't seen that one in a very long time in one day. Honestly, I would hope that does not happen because that's not good for anybody really long term, unless you're in a massive short and you might be happy, but no one else is. So that's not ideal, but that's what they are. So circuit breakers are very rare to be hit. We're in extreme times, and of course that is what it is. So great question. I think everyone is probably learning a little bit about that. The opening price is the fair price. Yes, the links will be emailed to you after this, so absolutely. Okay, here's one, Grant. Thanks for this question. So hedging is really just about account protection and stress management, not a money-making strategy, is that right? Look, you've obviously heard of hedge funds, okay? So hedging is really about pretty much getting rid of uncertainty. Now, in terms of, is it a way of potentially making money? That was a question before. Absolutely, it can be, because we can profit from both sides. We could potentially hedge a position. We could say, okay, go back to that Dow one just quickly. Go to the Dow. We can say, okay, we recognize that pattern. We know how the pattern length should be, and therefore we'll just hedge that position, and we're happy with this maybe being a key support area. So we could effectively double dip here. We've hedged the position, being the stock portfolio that we had, let's say. Market's come down, it's hit an area. We have taken the profit of the hedge. That's realized profit in your account. Obviously, your stocks are still down for that amount. The stocks increase. Now, if you were only the person that just held the stocks the whole time, well, guess what? Yes, you're back to zero, but the person that closed that hedge, well, they've profited the hedge position and they're back to zero on their stocks at this point, or back to the point they would have been. So that absolutely can be used that way. It just creates a point where you take the stress out of it and you can always deal in clarity. And I'm sure many people out there have traded, and look, we've all done this, and we've had nights where maybe things go a little bit crazy. And that's because we might have taken a few losses that we didn't, and then we saw the market go in the direction we wanted, and mistakes happen and are made. So very, very important to think about that. There are different VIXs. So Nicholas says VIX level 54 and Pepperstone's was slightly different. The VIXs are calculated slightly differently. It depends which market they're against. But in general essence, like when any of the VIXs are above 20, it's wild. How can I determine size, position, hedge from my portfolio? That's a good question. I didn't want to cover it because it's obviously a general webinar in terms of general information, but basically you'd be looking at, I think you would probably want to contact obviously Pepperstone, talk to them about what the contract size is per point, and then you would calculate the size of your portfolio, and then of course hedge it to the size of per point. So you basically work out what's a percentage on your portfolio, what's a percentage per point, and then you would move on from that point. All right, well, we are running a webinar straight after this that will be looking at, I guess, the market now. I know many people have asked this question. There's about 20 or 30 of them right now that have got these questions. So we will be looking at the live market. You're welcome to attend. I've put that in the chat room, and I will again put in Pepperstone's Telegram group because it's a great group for getting some tidbits of information, and I'll pop in our one as well, so that if you would like to, you can join the community. Look, it's obviously a very interesting time in the markets. We're seeing extreme volatility, and I do wish and hope everybody to have a safe trading time. And in terms of hedging, it's definitely something you can add to your trading arsenal, whether that might just be risk aversion on the weekend or potentially that portfolio kind of option. It's all there for you. You can even do it. You could do it pretty much on any of the positions. And sometimes you might be looking at a daily position and saying, okay, look, you know, at this point here, it breaks through here, I'm looking at shorts. And then you maybe say, okay, at this point here, I see support, I want to close my hedge, and you can do that and then maybe re-enter the hedge at a different point. So it can be a money maker. It just depends how you want to apply the strategy of hedging. Okay, well, thank you very much for attending today. Hopefully that helps everybody a little bit, and we may see you in the next webinar. Otherwise, we will see you in 2 weeks. And remember, hedging is about taking the uncertainty out of the market, and that's a very big, important thing to learn. All right, see everybody in 2 weeks. Thank you very much.